Provident Fund, Section 10, Subsection 11 and Section 10, Subsection 12 of Income Tax Act 1961 and Rule 9D of Income Tax Rules 1962. Types of Provident Funds. Now there are 4 types of Provident Fund. Statutory Provident Fund governed under Provident Fund Act 1925. This is for government and semi-government employees. Recognized Provident Fund governed under Employees Provident Fund Act 1952. This is for public and private sector employees. Public Provident Fund governed by Public Provident Fund Act 1968. Any member of the public, whether salaried or not, can open account with this fund. Unrecognized Provident Fund. If the Commissioner of Income Tax does not approve the Provident Fund scheme created by the employer and employee, then such scheme is an unrecognized Provident Fund scheme. Section 10, subsection 11. Any payment from a Provident Fund to which the Provident Fund Act 1925 applies, or from any other Provident Fund set up by the central government and notified by it in this behalf in the official gazette, is exempt from income tax. Amendment to Section 10, subsection 11 from financial year 21-22, that is from 1st of April 21, is as follows. However, if the contribution to the Provident Fund exceeds rupees 2,50,000, the interest on the amount exceeding 2,50,000 is taxable, and if there is no contribution made by the employer, then interest on the contribution exceeding rupees 5 lakhs is taxable. Let us understand this with the help of example, which is explained in Rule 9D of Income Tax Rules 1962. Mr. A is a member of a provident fund where the employer also makes an equal contribution. The contribution to his provident fund account for the financial year 21-22 is 3,50,000 and for the financial year 22-23 is 5,50,000. Compute his taxable liability for the financial year 21-22 and financial year 22-23, assuming the rate of interest is 8% per annum. Opening balance of PF account as on 31st of March 2021 is rupees 8,50,000. Now here, if you go to see, there is a bifurcation between your taxable contribution and non-taxable contribution. Opening balance as on 31st of March 2021 is non-taxable contribution. That is why 8,50,000 and the interest on it, which is 68,000, is not taxable, and that is why the closing balance of 9,18,000 as on 31st of March 2021 is non-taxable contribution. Now, contribution made during financial year 21-22 is 3,50,000, of which 2,50,000 is non-taxable contribution, on which the interest of 93,440 is not taxable, whereas the contribution of 1,50,000, which is taxable, on this interest of 12,000 is taxable. So for the financial year 31st of March 2022, your interest of rupees 12,000 has to be offered for tax. Similarly, in the case of financial year 22-23, the total contribution is 5,50,000, in which 2,50,000 is non-taxable, on which the cumulative interest on the closing balance comes to 1,20,915, which is non-taxable interest, whereas amount exceeding 2,50,000, that is 3 lakh, is taxable contribution, on which the interest of 36,960 is the taxable interest, and the closing balance comes to 4,98,960. Now this bifurcation will be done by the Provident Fund itself. So when an SSE gets her statement from the Provident Fund, it will be bifurcated between taxable contribution and non-taxable contribution. One more point to be noted is, in the case of taxable interest, if it exceeds 5,000, TDS will be deducted at the rate of 10%, uh, under section 194A. In case of an employer does not contribute to the Provident Fund, then interest on contribution made in excess of rupees 5 lakh is taxable as discussed in the previous slide. So in this case, if the employer doesn't make any contribution, then for the financial year 21-22, his contribution is 3,50,000, then it will be exempt, the entire contribution. And in the financial year 20 to 23, his contribution is 5,50,000. So 50,000 will be taxable and 5 lakh will be exempt. This will happen only if the employer does not make any contribution. Section 10, subsection 12, the accumulated balance due and becoming payable to an employee participating in a recognized provident fund to the extent provided in Rule 8 of Part A of the 4th schedule is exempt from tax. Amendment to Section 10(12) from financial year 21-22, that is from 1st of April 21, is, however, if the contribution to the Provident Fund exceeds rupees 2,50,000, then the interest on the amount exceeding rupees 2,50,000 is taxable, and if there is no contribution made by the employer, then the interest on the contribution exceeding rupees 5 lakh is taxable. This is the same amendment which is done in section 10 subsection 11. The same amendment is done in section 10 subsection 12 also. Now let us see what is Rule 8 of Part A of the 4th schedule. The accumulated balance due and becoming payable to the employee participating in a recognized provident fund shall be exempt from tax in the following cases. 1. If he has rendered continuous service with his employer for a period of 5 years or more, or second, if though he has not rendered such continuous service, the service has been terminated by reasons of employee's ill health or by the contraction or discontinuation of the employer's business or other causes beyond the control of the employee. Or third, if on the cessation of his employment, the employee obtains employment with any other employer and the accumulated PF balance due and becoming payable to him is transferred to any recognized provident fund maintained by other employer. This I will explain with the help of an example. Or fourth, if the entire balance standing to the credit of the employee is transferred to his account under a pension scheme referred to in section 80 CCD and notified by the central government. Now, what is a continuous period of 5 years? Now, suppose Mr. A is an employee of XYZ Limited. After serving for 3 years, he resigns from the company and joins PQR Limited. His PF balance of XYZ Limited is transferred to his PF balance in PQR Limited. He serves in PQR Limited for another 4 years and then withdraws his PF. Then his continuous service will be considered as 7 years. That is service of XYZ Limited of 3 years and service in PQR Limited of 4 years. So this is more than 5 years and hence this withdrawal is exempt from tax. So after he resigns from PQR Limited, if he withdraws the entire balance of PF, then it will be exempt from tax. Thank you. If you like the video, please click on the like button and subscribe to my YouTube channel.